Stop scrolling. This could be the most important update you've seen all year for IQD and VND holders. Both currencies are drawing fresh, serious attention from traders, investors, and everyday holders, and this attention isn't just social media noise. It's showing up in trading volumes, exchange rates, and policy discussion. Today, I will explain clearly and simply why the Iraqi dinar and the Vietnamese dong are trending in global Forex right now, what signals to watch, and practical steps you can take if you're involved. We'll separate fact from hype, show the exact kinds of data to follow, and give you sensible, low-draw guidance so you can act with information, not fear. If you're someone who has held these notes for years, or someone who watches Forex news casually, pay attention. Understanding the reasons behind a trend is the difference between making a smart move and falling for a rumor. We'll explain the economic changes, banking reforms, and international interest that are driving the conversation in straightforward to us English, without complicated jargon. Take time to follow official updates and combine them with market indicators to form a measured view. Why are fundamentals shifting in Iraq? Over recent months and quarters, the conversation around Iraq's economy has moved beyond political headlines and into policy details that can affect a currency. Think of fundamentals as the basic health markers of a country: budget assumptions, oil revenue flows, fiscal discipline, reserve levels, and reforms to banking and payment systems. Iraq's economy is heavily dependent on oil, and when oil receipts are managed with clearer budgets and transparent allocation, it gives policymakers room to stabilize currency expectations. At the same time, initiatives that aim to modernize banking, improve anti-corruption controls, and make it easier for businesses to convert and move money internationally reduce friction. Less friction means higher potential liquidity for the currency, and liquidity is a critical ingredient for any meaningful revaluation or realignment. So when people say IQD is trending, they are reacting to the intersection of these concrete shifts, not just online chatter. Watching the fundamentals helps separate short-term hype from real economic momentum. Take time to follow official updates and combine them with market indicators to form a measured view. Banking reforms and digital payments are core to why traders are watching IQD. When a country makes its domestic banking system more transparent and easier to use, it becomes more attractive to foreign banks and payment processors. For Iraq, practical steps like stricter oversight on currency exchanges, clearer rules for banks that hold foreign currency, and pilots for digital payments can all reduce the cost and risk of moving money in and out of the country. That matters because one of the historical obstacles for IQD has been illiquidity. Outside the region, it's hard to buy, sell, or settle the currency quickly and cheaply. Improving the infrastructure changes the calculus for institutional investors and global banks. They start to treat the currency as a tradable asset instead of a closed or risky position. As market participants begin to price in better access, volumes increase and price discovery becomes more meaningful. That is how technical trading and real-world policy actions come together to create visible trends. Take time to follow official updates and combine them with market indicators to form a measured view. Iraq's oil revenues and budget policy play a direct role in currency expectations. When a government that relies on commodity exports like oil publishes a stable budget and shows a clear plan for revenue management, it reduces uncertainty. Investors watch budget assumptions: how many barrels per day, what price per barrel is used in the budget, and how surplus revenue will be used. If the budget assumes conservative oil prices and still shows fiscal balance, that signals increasing resilience. Resilience encourages confidence in the currency because it suggests fewer emergency measures like sharp devaluations. Conversely, budgets that rely on optimistic oil prices or opaque spending create unpredictability. The key point is that the combination of stable budgeting and transparent management of oil receipts reduces the risk premium on a currency. As risk premium declines, even small flows of foreign capital can have an outsized effect on the exchange rate. That potential is what attracts traders and keeps IQD in the headlines. Take time to follow official updates and combine them with market indicators to form a measured view. The central bank's role is always central when currency talk turns serious. Official exchange rate settings, reserve management, and communication policy from the central bank are the clearest signals to markets. If central banks move toward clearer, more predictable policy frameworks, publishing official guidelines, tightening rules for currency trades, or offering clearer windows for conversion markets, interpret those moves as a reduction in uncertainty. For IQD specifically, an official rate used in the budget or announcements about how the bank will manage reserves and liquidity provide very concrete cues. Such cues tell foreign banks and traders whether they can rely on the official channel for meaningful conversions or whether they'll be forced into informal markets with higher costs. Clarity breeds participation. Participation increases liquidity, and increased liquidity makes price discovery realistic. That's the chain reaction that can turn talk into real market moves. Take time to follow official updates and combine them with market indicators to form a measured view. Market liquidity and exchange rate management are technical but crucial reasons currencies trend. Liquidity means there are enough buyers and sellers at reasonable prices so that large trades don't cause wild swings. For a currency like IQD that historically had limited global liquidity, any improvement in banking access, exchange licensing, or market infrastructure can meaningfully affect how the unit trades. When institutional players begin to test the market, placing orders, hedging positions, or offering quotes, their activities attract counterparties and professional market makers. That creates a feedback loop. Better liquidity attracts more participants, which improves pricing quality and reduces spreads. When you hear traders say, "watch the spreads" or "watch volume," they mean these metrics reveal how serious the market interest is. A trend in spreads or volumes, often the market's way of signaling the policy changes and real flows are aligning to make a sustained move possible. Take time to follow official updates and combine them with market indicators to form a measured view. Speculation and retail interest often amplify trends, for better or worse. When retail investors, collectors, and online communities begin to discuss a currency loudly, it draws attention from traders and sometimes from mainstream media. That attention can create short-term volatility as new buyers enter the market, but it can also force professional traders to take notice and test whether the activity reflects real underlying flows. Importantly, retail-driven spikes are often noisy. They can push prices up temporarily without the backing of sustained economic change. The healthy reaction for inexperienced traders is to look for confirmation. Are there changes in policy, foreign investment, or central bank action that back the chatter? If not, the spike can fade. If yes, the spike can be the beginning of a broader trend. For IQD and VND, the current environment mixes both factors: clear policy moves on the ground plus heightened retail interest. That combination is what makes the trend notable and worth following carefully. Take time to follow official updates and combine them with market indicators to form a measured view. Turning to Vietnam, the fundamentals have been strong, and that's a core reason traders are watching the dong. Vietnam's economy has been expanding by leveraging exports, manufacturing, and foreign direct investment. When an economy grows through trade and steadily attracts investment, it creates a natural case for currency strength over time. That's because growth leads to higher demand for local currency for payrolls, investment, and operational expenses. Policymakers in Hanoi have focused on modernizing banking, setting realistic credit targets, and encouraging investment that improves productivity. These actions lower the risk that capital will stay stuck or that foreign businesses will avoid transacting in the local currency. So, when international banks and funds review country risk, they see Vietnam as a place where business fundamentals increasingly support a stronger currency. That rising confidence shows up as attention on VND in Forex circles and as analysts update their models for potential appreciation over time. Take time to follow official updates and combine them with market indicators to form a measured view. Vietnam's trade and export strength is a powerful engine for VND demand. The country has become a major manufacturing hub for electronics, textiles, and consumer goods integrated into global supply chains. High export volumes translate into foreign currency earnings that must be converted into VND for local spending, investment, and government receipts. When exports grow faster than imports, or when foreign firms reinvest earnings locally, demand for the local currency increases. Moreover, large exporters often hedge currency exposures and work with local banks, which improves onshore market depth. For traders, growing exports combined with healthy foreign exchange reserves suggest lower vulnerability to external shocks and a smoother environment for appreciation. Therefore, when Vietnamese trade figures are strong, market models for VND appreciation become more credible, and that credibility draws attention from both macro traders and carry trade strategies. Take time to follow official updates and combine them with market indicators to form a measured view. The State Bank of Vietnam's policy choices matter a lot to the VND outlook. Clear credit targets, managed rate approaches, and transparent communication help markets form realistic expectation. When the central bank sets concrete credit growth or inflation objectives and sticks to visible frameworks, investors get confidence that monetary policy is not going to swing wildly. That stability reduces risk premiums and improves the appeal of local assets denominated in VND. Although central banks often avoid promising specific exchange rate moves, their guidance on credit, interest rates, and reserve management signals whether they are comfortable allowing gradual appreciation or will defend a certain band. For traders, the most important cues are the central bank statements, auction activity, and issuing of reserves data. These signals, when consistent with a growing economy, create an environment where the dong can be priced for gradual strengthening rather than chronic weakness. Take time to follow official updates and combine them with market indicators to form a measured view. Foreign direct investment and capital flows into Vietnam are another major driver of VND interest. When multinational companies set up factories or expand operations, they bring in capital, technology, and recurring demand for local currency. Those inflows are not speculative short-term flows, they are often longer-term commitments tied to physical investment and hiring. That type of money is stabilizing because it reduces the odds of sudden reversals. As FDI increases, the onshore banking sector grows in capability to handle larger corporate flows and local markets mature. Mature markets with real economic activity are more attractive to institutional investors and funds, which in turn improves liquidity and reduces the cost of transacting in VND. This process is a structural reason why the dong is drawing attention and not merely a short-lived headline story. Take time to follow official updates and combine them with market indicators to form a measured view. Technical trading signs are how professionals translate policy changes and market flows into trading decisions. Traders look at volume spikes, narrowing or widening bid-ask spreads, and the presence of consistent buying or selling at key levels. For IQD and VND, early technical signs that markets are moving beyond rumor include sustained volume increases during business hours in relevant regional markets, tighter execution spreads offered by market makers, and deeper order books. Another key sign is when non-traditional liquidity providers, like regional commodity traders or corporate treasuries, start offering quotes. That indicates participants are testing the market and are willing to transact at scale. When technical and onshore indicators line up with policy signals, institutional traders begin to open larger positions and deploy hedging strategies, which can accelerate price discovery. Watching those technical signs helps separate noise from a real structural move. Take time to follow official updates and combine them with market indicators to form a measured view. Understanding how revaluation talk translates to price moves is important. Revaluation implies an official or semi-official policy-driven change in the currency's exchange rate regime or its official band. But markets can move in advance of such an official act if traders price in a high probability that the central bank or government will allow a change. That pre-positioning results in actual market prices shifting sometimes well before any government notice because traders want to lock in gains or hedge against potential moves. Conversely, if official announcements contradict market expectations, prices can snap back quickly. The takeaway is that talk of revaluation creates two separate risks: market-driven moves as traders price in the possibility, and policy-driven outcomes when authorities act. Both outcomes can move money, but the mechanics and timing differ. So being clear about which path seems likely is essential for planning. Take time to follow official updates and combine them with market indicators to form a measured view. Risks and red flags for IQD holders are real and deserve attention. Historically, the Iraqi dinar has been subject to low international liquidity governance concerns, and the risk that official policies will change unexpectedly in response to political or fiscal pressures. In addition, fake investment schemes and misleading IV promises have been widespread, preying on hope rather than fact. If you hold IQD, consider practical exposures. How easily can you access your money if you want to liquidate? What are the fees and timeframes at official channels? And how credible are any claims you hear online? Always demand verified communication from central banks or mainstream financial institutions before acting on big claims. A prudent approach balances the potential upside with an honest look at these operational and political risks, and it emphasizes preservation of capital for things you cannot easily replace. Take time to follow official updates and combine them with market indicators to form a measured view. Risks and red flags for VND holders are different but no less important. Although Vietnam's economy looks solid, exchange rate outcomes depend on policy choices, global demand, and external shocks. Rapid capital inflows can reverse quickly if external conditions change, and corporate hedging strategies can add volatility. Moreover, local regulations control how quickly foreigners can repatriate profits and how certain financial instruments are used for holders. It's important to understand the liquidity of the instrument you hold. Cash notes versus bank accounts or bonds. Each has different access rules and conversion costs. Additionally, avoid any offer that promises guaranteed windfalls tied to vague revaluation timelines. Good practice is to verify any claims with credible financial institutions and to view growth in VND interest as a process rather than a guaranteed overnight event. Take time to follow official updates and combine them with market indicators to form a measured view. Practical steps for holders focus on liquidity, documentation, and realistic expectations. If you are holding paper, IQD, or VND, make sure you know where and how you can convert or deposit those notes locally or internationally. Check fees, identify licensed exchange centers, and confirm whether your local bank will accept the currency for deposit. If you are holding digital balances, verify custody arrangements and withdrawal conditions. Second, document provenance and receipts for your holdings. Legitimate exchange or banking channels will often require proof if large amounts are involved. Third, avoid concentration risk. Don't bet your financial life on a single speculative outcome. Keep emergency funds in liquid, well-understood assets while you monitor any revaluation possibilities. Finally, practice patience. Meaningful currency policy moves are often signaled well in advance through budgets, central bank guidance, and measured reforms. Use those signs to guide your decisions and avoid impulsive choices driven by headlines. Take time to follow official updates and combine them with market indicators to form a measured view. Practical steps for traders center on risk management, position sizing, and diversification. If you trade currencies professionally or as an experienced retail trader, treat IQD and VND moves as event-driven trades that can have both sharp directional risk and strong liquidity shifts. Use stop losses, define clear risk-reward ratios, and avoid oversized positions that could be hard to unwind if liquidity dries up. Consider hedging strategies that use correlated assets or options where available, and avoid relying solely on social chatter. Professional traders will watch central bank windows, auction results, and onshore flows carefully and will often scale into positions as confirmation appears. For most retail traders, smaller, disciplined exposure or using paper trading to rehearse reactions is a smarter path than speculative all-in bets. Take time to follow official updates and combine them with market indicators to form a measured view. Global FX trends and the strength of the US dollar play a major role in how regional currencies move. When the dollar strengthens globally, it can offset local improvements and make appreciation in emerging market currencies harder in the short term. Conversely, a softer dollar gives local currencies more room to appreciate if their domestic fundamentals support it. In 2026, macro conditions like global growth expectations, commodity prices, and central bank divergence matter for both IQD and VND. External context like trends in oil pricing for Iraq or global demand for manufactured exports for Vietnam interacts with domestic policy to shape outcomes. Traders who watch only local headlines and ignore the global backdrop can miss important countervailing pressures. So always consider both local structure and the international environment when evaluating currency moves. Take time to follow official updates and combine them with market indicators to form a measured view. Local policy and governance determine how durable any currency move will be. Currency revaluation or appreciation is more sustainable when governments commit to transparent fiscal frameworks, predictable monetary policy, and gradual structural reforms that improve the business environment. Weak governance or sudden policy reversals can erase gains quickly. Therefore, when you hear talk of historic moves, ask whether the legal and institutional framework supports the change over time. Sustained improvement in rule of law, contract enforcement, and clear regulatory processes attracts long-term capital, not just speculative money. The more durable the reform program, the higher the chance that market moves will persist rather than reverse when short-term pressures shift. Take time to follow official updates and combine them with market indicators to form a measured view. Emotional and behavioral factors are powerful in currency stories. Hope and fear spread fast on social media, and investment narratives that promise quick riches can attract inexperienced participants. That surge of attention can cause price spikes that are not backed by fundamentals and can end badly for late entrants. Recognize common behavioral traps. Confirmation bias. Seeing only information that supports your wish, hurting doing what everyone else does, and recency bias. Believing recent patterns will continue forever. A calmer approach is to look for multiple confirmations, policy signals, liquidity changes, and credible institutional participation before increasing exposure. If you find yourself making emotional decisions, step back and apply clear rules on position sizing and risk. That discipline will protect you during sudden reversals. Take time to follow official updates and combine them with market indicators to form a measured view. How to verify official announcements and avoid scams is practical and essential. Always look for communications from official institutions, central banks, finance ministries, or licensed exchanges rather than unverified social posts. Official channels will publish clear statements on policy changes, auction results, or official rate adjustments. If someone promises guaranteed large returns from a pending RV or revaluation without clear evidence, treat it as a red flag. Scammers often use urgency, insider-sounding language, and pressure tactics to convince people to move funds quickly. If you are unsure, consult with trusted financial professionals or local banks before taking action. Keeping skepticism and verification as default behaviors will save time and protect your capital in most cases. Take time to follow official updates and combine them with market indicators to form a measured view. The long-term outlook for both IQD and VND must consider multiple scenarios. In one scenario, gradual structural reforms, improved budgets, and steady capital inflows lead to slow but sustainable appreciation as liquidity deepens and investor confidence grows. In another, political setbacks or unexpected external shocks could slow or reverse gains, leaving speculative bubbles to deflate. A balanced view recognizes both possibilities and plans around them. Diversify holdings, keep clear liquidity buffers, and be ready to act if credible policy signals appear. Over the medium to long term, the most likely path for currencies tied to improving economies is gradual normalization rather than overnight miracles. That means patient monitoring and disciplined planning rather than hoping for an immediate windfall. It's the steady, sensible approach that usually wins in currency markets over time. Take time to follow official updates and combine them with market indicators to form a measured view.